For the past year, Salesforce has been through the ringer. In December, the co-CEO Brett Taylor resigned. The next month, they laid off 10% of the staff, and just weeks later, they were targeted by activist investment firm Elliott Management. Elliott's demands were simple: focus on profits and cut costs dramatically. Well, it appears Salesforce has listened. The company's Q2 earnings report showed that quarterly net income rose from $68 million to $1.3 billion. That's a near 20-fold increase. Salesforce also reported a 31.6% operating margin and raised its annual margin guidance to 30%. CEO Mark Benioff had aimed to hit this milestone in 2025 and said that reaching it this year was, quote, nothing short of a miracle. Salesforce shares jumped 6% on the news. Scott, reactions to that?
Here's the thing. Cost cutting is a lot of fun from a shareholder standpoint if there's costs to be cut. And when you stuff so many calories down the esophagus of a growth company that it develops fat everywhere, you can do one of two things to add the same amount of earnings. Say the operating margins are 20 points, which is very healthy operating margins. You can either grow your top line by $5 billion or cut costs $1 billion. Same effect to your earnings. So when you actually come to the conclusion that we're a little bit overweight, maybe even obese here, and we're going to go on a diet, and it's not fun, and there's so much pattern recognition and expectation that we're going to keep investing, keep hiring, keep spending, keep growing, the cost cutting can be just incredibly powerful, especially if it doesn't have an impact on frontline sales. So as we predicted last year, and we're sticking to this prediction, I think in Q4 of this year, you're going to see record earnings across big tech because they've discovered the great taste of cost cutting without the calories of losing revenue growth, because there appeared to be just thousands, if not tens of thousands of people doing almost no fucking work. And so this is, this is kind of the perfect activist play. And Salesforce is really sort of embodies the best of this year of efficiency. And it also is sort of a testament to the power and the importance that activists play in the ecosystem. Elliott came in. Elliott needs a company where they can put billions of dollars to work because they've raised a shit ton of money because of their success. And they look at Salesforce and like, great company, great leadership. You just spent too much money. You're just fat and you're drunk and you got to tighten the ship. And to a certain extent, I don't want to say it's a favor to Benioff, but it creates cloud cover for him to make really difficult decisions.
Yeah.
And what they found is these difficult decisions were difficult from a personal standpoint, difficult from a cultural standpoint that's never known anything but growth and investment. But oh my gosh, was this a spring waiting to be sprung? And that is that it does not appear to have affected their growth. So if you can maintain growth and cut costs at the same time, oh my God, champagne and cocaine for earnings, as evidenced by the fact that earnings went up 20-fold. So, and this is perfect for Elliott. Elliott doesn't have to fire the CEO. They don't have to stick around a long time. They just go in and say, you obviously have room to cut costs. Mark says, I get it. He does it. Elliott makes a shit ton of money. The stock recovers. And Benioff is seen as the CEO who's kind of taken him through the haunted forest here and come out the other end fine. So I think this is where you say the market is a wonderful thing and capitalism works, but this is an activist play that appears to be working out for all parties. And while everyone's focused on Meta's cost cutting, I think the real example of kind of where it worked out for everybody, obviously except for the people who got laid off, but my guess is they're going to be just fine in an economy that has historically low unemployment. This just just felt like win-win-win across the board.
You had a pretty good example of their exuberant spending yesterday, specifically Pivot's deal with Salesforce. Could you explain that?
Salesforce launched something called Salesforce Plus, which was a streaming network for Salesforce, and they paid us a lot of money for clips from Pivot. Which
can you disclose how much?
I cannot.
Okay.
And we're not doing it again this year. My guess is that was like a fairly quick decision, and I'd like to think they got return on it. But a streaming network from a CRM company is probably indicative of a company that might be overinvesting. And you need to make these types of bets, but I think they decided, I don't know the status of Salesforce Plus, but I don't hear very many people talking about it. So my guess is they probably cut it and cut costs sooner than they would have otherwise under the auspices of the pressure of an activist. And while, we love that revenue, you understand what's going on. They were doing a lot of experimentation. I mean, Google's been through this. Google startup, Ruth Porat, the CFO, came in from Morgan Stanley. The first thing she did was she just went down the list and said, these things make no fucking sense. Stop trying to cure death. Stop with the flying cars. We're just going to focus on this thing called search and YouTube and the shit that makes a lot of money or has a discernible path to making a lot of money. Mm-hmm. And, she was literally able, she didn't find change in the couch cushions. She found tens of billions of dollars just sitting there waiting and cost waiting to be cut. So, yeah, I think a lot of people in the ecosystem, including us at Pivot, felt some of those cost cuts, but I'm sure that another fantastic company will come in and buy our ads, Ed.
So you mentioned this idea of cutting costs without having to sacrifice anything on the top line, on your revenue, which is true of some companies. It's currently true of Salesforce. We are seeing revenue growth, but we'll see if that lasts over the next few quarters. But if you look at the entire SaaS ecosystem, it's sort of a different story. So they're all pursuing the same strategy, which is cut costs, focus on profitability. 3 years ago, SaaS companies were averaging around 5% in free cash flow margins. That number is up to 13%. But it does appear that it has come at a sacrifice to revenue growth. So in 2020, in that same period, average revenue growth across SaaS firms was 22%. That number is now down to 15%. So is there an argument to be made here that maybe these software and SaaS companies are overcorrecting, that they're playing too defensive in terms of pursuing profitability, and maybe they should be taking risks and investing in new technologies and finding new growth opportunities so that they can expand revenue in the top line? What are your thoughts on that?
Well, so the question comes down to this. Is that decline in revenue growth a function of a lack of investment or the fact that the economy's just slowed down, things have gotten more competitive, and the kind of crazy big gulp grande vente ayahuasca trip that every small company was on with cheap capital, that is always a big part of a customer base for a SaaS company. There just aren't as many of them signing up more and more people for the Salesforce platform or what have you, or the Snowflake, or name it. And so SaaS, just the SaaS market, which grew exponentially, that growth is slowing down regardless of how much money they threw at it. I would argue that the incremental or the cuts in expenditure did not have, at least in the SaaS market, is not the culprit. The culprit is the larger economy and the macro environment. And had they continued to make those investments, their growth wouldn't have been much greater. It's just their bottom line would have been much, much smaller. So my gut and the data I've seen is that these cost cuts were prudent and have had actually very little impact on what the top line growth would have been otherwise.